one of my clients came to me and wanted to buy a business. Self-employed, already owned one business, buying a second one. He had one owner-occupied property and wanted to see firstly if he can buy the business or not. With the right cash flow statement, business plan, we got him the business loan. Business started working out well. In 2.5 years, he's gone from one property to 5 properties now.
And that's the benefit of using a mortgage broker who can give you all those options of all the lenders that do have specialties in self-employed.
You've got a good business plan. If the business grow at such trajectory, this is how we're going to structure each loan. And it started to happen one after the other, and now he's got 5 properties.
Well, Aseem, over the last few months, your clients have seen with your property investment series, they've seen you and heard you interview experts across the property investment journey. And now it's your turn to be in the hot seat as the expert around the mortgage broking aspect of property investment for your clients. So why is finance the first step in a property investment strategy?
Well, finance is fuel. I mean, the first thing before you start buying into a property, you need to find out what your budget is. A good mortgage broker will work out the numbers, give you the right figure that not only gives you the clarity, but also the confidence. And then you can go and negotiate it better too. So finance is everything.
Your clients would have heard terms about getting pre-approval, getting full approval. And for a lot of people, this is really finance jargon that they don't understand. So what does that mean? What's the difference between pre-approval and full approval?
So pre-approval is basically working on what your borrowing capacity is. Let me give you an example. So let's say you get into a VIP list. That's pre-approval. But when you actually get in the door and grab a drink, that's full approval. So basically full approval is where bank has validated all the supporting documents, checked the property, and they're fully committed towards the purchase. Until it's not fully approved, it's not final.
What's the biggest loan structuring mistake that you see investors make?
It's a great question. With loan structuring, I see often that client comes to me where they have 3 properties, but all 3 of them cross-collateralized. Yes, it has its place, but at the right time. When you have all the properties cross-collateralized, it doesn't give you that flexibility to move and access the equity at times. So for example, if you wanted to buy a property in a different structure, you wanted to use the equity from there, that means because they're cross-collateralized, you need to refinance it all together. Because what happens, I'll give you a real example. One of my clients had 2 properties. One was owner-occupied, one was investment. They were both cross-collateralized. Now, when we wanted to buy the 3rd property, we wanted to use the equity from the investment property. Now, investment property has gone up in value in the last 2 years, but the owner-occupied, given that was in Victoria, has actually gone down in value. So because they were cross-collateralized, when we worked out the end borrowing capacity, the end equity available to use it for the purchase, there wasn't enough there. But if we had it split in individual names, individual banks, or whatever it may be, they were not linked to each other, we had more room to play with, and we will be able to get another property.
What do you think has changed the most in lending over the last 5 years?
There's a lot change, in fact, starting from the Royal Commission and then through to COVID and interest rates going up and down. I think mainly from the Royal Commission onwards, things which have changed is focus more on living expenses. So banks want to go through in more details what your spending habits are, and based on that, your borrowing capacity is calculated. So things like, if you're paying private school fees, paying private health insurance, or all these other additional expenses, if you're dining out too much, they all come into play now working out your borrowing capacity. So I say to the investors, be careful, if you have a goal to increase your property portfolio, make sure you manage and budget them very well.
How should investors think about equity?
Equity is great, but should only be used to fuel the growth. It's not a slush fund. So ideally, the equity, if you have a goal to increase your portfolio, to only be used for growing assets. So if you're buying another property or renovating and uplifting an existing property, but often, investors get that, confused with, okay, there are extra funds available for me to use, but if you use them funds now for a holiday or something else, which is not going towards the right asset, then you won't have that opportunity to grow that when the time comes.
You touched on interest rate changes before, and so this is the $1,000,000 question for investors. Do you go fixed? Do you go variable? Do you split? What do you recommend, and how do you come to that recommendation?
A lot of that is dictated towards the market and where the market trajectory is going. When after COVID, interest rate starts to go up, a lot of people fix their rates at the right time. They were lucky enough, but there were some who were not enough lucky, and they were kept on variable rate. Rates kept on going up and up and up. Your borrowing capacities started to reduce. But I think it's important to have a good balance. If the market is going down now, like, you keep it at variable. When you see the market is going towards its bottom, that's a good time to fix it. There's a benefit of fixing it, which is, it gives you a fixed budget you can work with. Let's say you fix it for 2 years. You know what you're going to spend for the next 2 years. It's easy to budget around it. When it's variable, it can go up and down, and you don't know what's happening. But you can make a plan for it. If you have the right mortgage broker in place, they can guide you through all these complexities.
What about interest-only loans for investors? What's your view on that?
Interest only can be good for cash flow and tax strategy, but they're not for everyone. So with the right strategy in place, it definitely has a spot, but it's not for every transaction. So be very careful just going straight into interest only. Work with the advice from your mortgage broker.
Yeah, absolutely. What about if I'm self-employed? Can I still get finance?
Nowadays, there's a lot of options out there for self-employed people. Yes, there are more documentations required. Bank wants to see that you can sustain your income in an ongoing basis. So that's why they want to ask for last 2 year financials to see how the business is going in a long-term frame of mind. But if you have too much of a complex structure, or you haven't got enough documentation available, there are alternate document options available with different lenders. Now, they also come with competitive rates. So, it's self-employed, I say, I love working with self-employed people because there's a lot more flexibility available for self-employed in the market now. One of my clients came to me and wanted to buy a business. Self-employed, already owned one business, buying a second one. He had one owner-occupied property and wanted to see firstly if he can buy the business or not. But the right cash flow statement, business plan, we got him the business loan. Business started working out well. In 2.5 years, he's gone from 1 property to 5 properties now. So he's got that extra 4 properties because we had the plan in place from the beginning. Okay, you've got a good business plan. If the business grow at such trajectory, this is how we're going to structure each loan. And it started to happen one after the other. And now he's got 5 properties.
And that's the benefit of using a mortgage broker who can give you all those options of all the lenders that do have specialties in self-employed. So that is just another one of the many benefits of seeing someone like you who is an expert and who is across all the different lenders and can get the best deal for the client's circumstances.
Absolutely.
Is it harder to get finance through a trust or self-managed super fund?
It is more complex. It is not necessarily harder. If your broker knows what they're doing, they can navigate through those complexities. But as a client, yes, you have to follow certain steps. Make sure you have appropriate documentation in place, like setting up a SMSF if you don't already have one. And you need to get your accountant involved in that too. But generally, experienced mortgage broker who's done those sort of things can guide you through the process. And from a client's perspective, it's a great tool. I mean, they can, your SMSF borrowing doesn't form part of your actual borrowing capacity. That can stay outside that, and you can add another property to your portfolio. So absolutely, it is, yes, it's more complex, but can be done easily.
When you get the right advice from the right experts.
Exactly right.
What do investors often get wrong when growing a portfolio?
Yeah, great question. Investors often, talk about the equity they have available, and as I touched earlier, that when they start to see that equity is growing as well, they tend to spend more as the income is growing, properties are growing, assets are growing. If you want to grow your portfolio and that's your main goal, you need to watch your borrowing capacity. You need to watch your expenses. You need to make sure the budgeting is done correctly so that you have plan in place. There's enough personal disposable income that you're saving more and more so that you get into the next property and the next and then the one after that.
Part of the loan application is getting the valuation done on the property. So what happens, or what do you do if the valuation comes in lower than expected?
Firstly, don't panic, and speak to a broker or speak to me. Well, look, there's a lot of options out there. Valuation comes down low. Often that's happening in current market. A broker would have access to different lenders where you can access, valuations from different lenders and different other valuer firm. And if after going through all of that process, it's still not stacking up, maybe that's a time you need to have an open conversation with your client saying, is this the right purchase strategy you have in place? So, for a normal average property, that can be easily fixed.
Should investors refinance on a regular basis?
They should definitely do a health check after every 12 to 18 months. But your broker would be able to advise, okay, if refinancing this property is the best option for them or not. At times, they are currently on a good rate, good structure. They don't need to change it. If they feel, okay, they might be paying a little bit higher, if there's an opportunity to get a better pricing, which will lower the repayment, improve their cash flow, then why not? But for the right client at the right circumstances, yes, you should definitely do a health check, but refinance case by case.
Do you do annual health checks on your clients? What do you do?
Yeah, annual health checks are the norm. If they're on a 2 years fixed, we normally go closer to the end of the term of the fixed rate. But yeah, annually health checks are very important because market in Australia is constantly changing. RBA is changing rates nowadays, a lot of activity. So it's important for us to be on top of our clients' interest rates and what structure they have is the right structure in place for them.
Yeah, awesome. What's your number one tip for somebody who's watching this video series and wants to become a first-time investor?
Firstly, get a good team in place. You have the right mortgage broker, good accountant, and good property advisor. You have the right people in place. They'll do all the magic. You just sit back and relax. And don't stress. There are people there who can help you out in the whole journey. It can be done. You just need to do your numbers, get across that, and it can be done.
What about a tip for someone who's got a fairly large property portfolio? So maybe someone with 3+ properties.
Yeah, well, for someone who's trying to increase their portfolio, they're not really a property buyer anymore. They're property managers. So they need to look at each property, their portfolio as a whole, and what value it is adding them, and have a long-term strategy in place for them. Okay, when you're planning to exit out of that property, or if you want to keep it, what's your end goal? Is it for tax benefit, or is it for capital growth? Where you're heading, and make sure you keep open communication with your mortgage broker. That way we can plan ahead to see if you're looking to purchase another property. Let's say the interest rates are going down now. So maybe you could afford 3 properties 6 months ago. You might be able to afford a 4th one now. So it's a good time to get into the market. It's still flat. Rates are going down. Borrowing capacity is increasing. But important to keep that channel of communication open with mortgage broker.
What's a finance myth that drives you crazy?
Oh, can I just be very honest? I'm an ex-banker, by the way. When some client comes to me and said, I like my bank, they know me there, I'm happy with them. That really drives me crazy because yes, they can help you out for the products they have available. But when you come to a mortgage broker, they have products available across the board with different lenders. So we work with 30+ lenders, for example. And, that bank might be a good bank, but that might not be the right bank for your needs. So I think loyalty is great, but loyalty is not going to get you the best deal.
Yeah. I always think a bank is the advocate for the bank and the broker is the advocate for the customer.
And spot on. And that, proof is right there in the market that over 75% of the loans are written by the brokers. So this is the right place to be. Yeah. So pick up the phone and call.
Why should property investors come and see you?
Come and see me. Okay. Firstly, mortgage broker. As an experienced mortgage broker, I've gone through a lot of different structure, a lot of different client base. So if there is situation or complexity you have, there's more chances that we would have looked after that complexity. So, coming to us, you're coming to someone who's got banking experience, now as a broker, over 17 years in the industry. So we've seen both sides of the coin and seen the market through the GFC, through COVID and all that. So can guide you through different challenges you'll face in your property journey. But treat me as your trusted advisor. Just come to us, we help you support. Even if you're not able to help you out, we are there to share our knowledge with you.
And get people on the journey to be able to become a property investor.
Exactly right.
Awesome. Thank you.
Thank you.